Credit helps you to get the things you need now, like a loan for a car or a credit card, based on your promise to pay later. Working to improve your credit helps ensure you'll qualify for loans when you need them. By working to build and maintain good credit, you set yourself up to receive the best possible terms when it comes to borrowing. There are many types of credit. The two most common types are installment loans and revolving credit. Installment loans are a set amount of money loaned to you to use for a specific purpose. Common examples of installment loans: student loans and auto loans. Revolving credit is a line of credit you can keep using after paying it off. You can make purchases with it as long as the balance stays under the credit limit, which can change over time. Credit cards are the most common type of revolving credit. When it comes to credit cards, not all of them are the same. Make sure you explore all pros and cons of credit cards when choosing the right one for you. By the way, welcome to Money Matters. Our goal is to give you the best tools, advice, and up-to-date tips and strategies so that you can live your best life. If you enjoy content like this, don't forget to hit the like button, subscribe, and turn on the notification bell for up-to-date information. In this video, we are going to discuss how to build and maintain good credit. At first, establishing credit may seem frustrating. You can't get credit because you've never had credit, or you can't rebuild your credit because you've had credit problems in the past. Here are some steps you can take to start establishing a strong credit history. Number 1. Establish a relationship with your financial institution, opening a savings account or checking account. Number 2. Set a goal to not spend more than you can pay back when the bill is due. Over time, the bank will see that you are reliable and trustworthy to repay a loan. Number 3. Get 1 or 2 gasoline or department store credit cards and pay your bills on time, every month. Number 4. Take out a small loan for a household appliance or a computer and repay it monthly, in full and on time. Number 5. Put your apartment and utilities in your own name and always pay your bills on time. Number 6. Get a secured credit card by opening a savings account with a balance equal to the credit limit of the card. Or if you qualify, get a regular unsecured credit card. Once you start using credit, it's important to manage it properly. By using all of your credit responsibly, you can go a long way in building strong and healthy credit. Keep your credit card debt low enough so that you can pay it in full every month. If you have to carry a balance, a good guideline is to keep your credit card balance below 30% of your limit at all times. This will help you build credit by showing lenders that you can control how much credit you use, and it leaves enough credit available in case of an emergency. When you're starting out with credit cards, consider having just one card with a low spending limit. This will help you start to get comfortable using credit and paying it back, and will stop you from getting into big trouble with debt. The Fico Score, used by 90% of top lenders in the United States, analyzes the information on your credit report. Then, it predicts how likely you are to pay a bill 90 days late, or worse, within the next 24 months. Fico scoring models rank order credit reports on a scale of 300 to 850. If your score falls on the higher end of that range, you have a good credit score. That higher score tells lenders you're less likely to fall seriously behind on credit obligations. In order to build and maintain good credit, you need to know what goes into your Fico credit score. Fico analyzes data from your credit report and groups them into 5 categories: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. These are the categories and how heavily they impact your credit score. By focusing on each of these areas, you can increase your credit score over time. The first thing any lender wants to know is whether you've paid past credit accounts on time. This helps a lender figure out the amount of risk it will take on when extending credit. This is the most important factor in a FICO score. Having credit accounts and owing money on them does not necessarily mean you are a high-risk borrower. However, if you are using a lot of your available credit, this may indicate that you are overextended, and banks can interpret this to mean that you are at a higher risk of defaulting. A longer credit history will increase your FICO scores. However, even people who haven't been using credit for long may have high FICO scores, depending on how the rest of their credit report looks. Your FICO score takes into account how long your credit accounts have been established, including the age of your oldest account, the age of your newest account, and an average age of all your accounts. FICO scores will consider your mix of credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Don't worry, it's not necessary to have one of each. Last factor is new credit. Research shows that opening several credit accounts in a short amount of time represents a greater risk, especially for people who don't have a long credit history. If you can avoid it, try not to open a bunch of accounts in a short period. Checking your credit score helps you predict how borrowers will view your applications for credit cards or loans. If you see that your credit score is lower than you want, you have an opportunity to improve your score before you take major financial steps. That's all for today's video. Comment below with your thoughts and let us know if we missed anything. If you are new here, welcome. Subscribe to our channel for more amazing videos like this. Thanks for watching, and don't forget, money matters. Get